Before I even start off about what an IPO is, give people a sense of how big the market is for 2017 in terms of offerings that we have and the amount of money that's going to be hitting the market.
So we've already seen a pretty good beginning to 2017-18, and about 10 IPOs have already hit the market, and close to 9,000 crores has already been raised.
Yeah.
We also have a good pipeline, as you were just mentioning. So about 12 companies are holding approval from SEBI. And we can talk a bit more about, what is the stage of a company coming out with an IPO. But pretty much getting the SEBI approval is the final stage, which a company has to cross before they launch their IPO. And there are about 12 companies which are holding that, and they are collectively looking to raise about 7,000 odd crores as well. At the same time, you've got another 10 odd companies which have filed their offer document with SEBI for their approval, which are looking to raise close to 20,000 crores. So in case all of this were to materialize, as you rightly said, that this is likely to be one of the best years and probably the best ever since the IPO markets in India.
Yeah. So it started in 2016, Pranav. So people have a little bit of an idea of what IPOs are about.
We understand that all companies need to have some capital to expand, to grow, etc., etc. So there's equity capital and there's debt capital. So as a promoter of a company or a founder of a company or the management of a company, I have an option that either I can approach banks and I can say that, look, this is my business, these are my revenues, I need a loan of XYZ amount, and this is the interest which I'll pay to you. So that is debt capital. So as we know, as far as debt is concerned, you need to repay your interest at a defined period, and then you need to pay the principal at the end of the loan period. The other option that companies have is to go to the equity capital market side, which is, say that, at the time of founding the company, you have 100% stake in the company. You say that, look, I'm willing to divest 5%, 10%, 15%, 20%, and you give me X amount of money. And, that is derived on the basis of the valuation which is done of the business. Valuation takes into account, the revenues, the profitability, future prospects of the company. So this is another option which the company has to go to the equity capital market route.
Yeah.
And here, either he can explore private capital or he can explore public capital. So as we know, private capital can be explored when we talk about private equity and venture capital. So there are firms which are willing to invest in unlisted small companies which represent exciting businesses and strong growth going forward. Or the other option that a company has is to go to the public market, and which is where an IPO comes in, which is an initial public offering. So a company comes and offers its shares to the public at large. So individual investors, retail investors can come and invest their money.
So why an IPO? For a person who doesn't know this market, why not just go and buy a stock that everybody recommends, or why not look at a mutual fund that holds a bunch of stocks? Why are people so drawn to an IPO?
Well, traditionally, if one were to go back in history, earlier there used to be a regulatory authority which used to define the pricing of IPOs. And there was an artificial
Please don't say traditionally back in history, Pranav. I feel so old because I recognize that era.
This was before SEBI came into existence, and so we are talking about the 80s. And they used to, after studying the company, they used to say that this is the price at which you can offer your shares to the market, which was artificial. And as a result of that, when the shares would get listed on the secondary market, you would see a huge upside.
Yeah.
So unfortunately in India, for some reason, this perception has got created, and especially in the minds of retail investors, that IPO represents 100% upside opportunity. I would like to say through your program that that is not the case. In fact, if anything, IPOs and new companies which are coming are even riskier than putting your money into a company which is already listed on the secondary market. Because at the time of IPO, the information which is available about the company is limited. You don't know, what the future holds. While, as far as a company which is there in the secondary market, you have disclosures which are coming out.
You've seen it through stages of business cycles.
You've seen it through multiple stages. So it represents far lower risk than a completely fresh company coming to the IPO market. But you do see a lot of interest because of this history that you've seen in terms of IPOs giving very high returns. In fact, as we are talking in 2017, there have been IPOs which have given 60, 70, 100, 150% return on the day of listing. But I would still say that retail investors would do better to always go through the mutual fund route. Whether for an IPO, we've already seen a few domestic mutual funds which have launched dedicated schemes which are only meant for investment in IPOs. So if you do want to, expose yourself to companies which are coming up, which is a good idea, but do it through a mutual fund route, because there's a professional fund manager who can take a call on your behalf whether a particular IPO is a good investment or a bad investment.